little recording notification. Make sure you check that you are being recorded, just so you know. All right. Well, good afternoon. We have talked for a number of weeks now about gross product and the trading account in that Ranching for Profit presents and the way we use it in QuickBooks. I want to go through today. We've been talking about the factors that drive gross product. And we are kind of getting towards the end of that. I'm going to get a little abstract today because we're actually going to talk about asset turnover within the context of gross product. And I think it'll become pretty clear why we're doing that. I want to talk about, using our assets to obviously generate more income. And then when we get to the end, towards the end, we're going to talk about this Kiyosaki ratio, which is a ratio we've sort of come up with here. That helps us understand how what we own contributes to the money we make. I think there are no more critical questions than, what assets do we choose to own? Where do we choose to put our money? And then how does that sort of come back to us? So with that, I'll get started. I'm going to share my screen. If you would like, please feel free to interrupt me while we're going. So if there's anything you don't understand, let me know. I'm going to show you a little bit of theory, a couple of equations, and then we're going to get into examples from in the wild. So we'll go from there. And let me see if I can run this correctly on both screens. Can everybody see my second slide? A couple of bullet points under the profit equation. Okay.
Yes.
All right. Good. Perfect. Thank you. All right. So we've talked about this a couple times. This is repeat. And so the first few slides of this are ones we've talked about each time we've talked about the gross product. I kind of want you to get sick of this to the point that you really know it. I know I'm being very repetitive. We have a saying at church that is, concepts will be repeated until they are understood. And, which is similar to beatings will continue until morale improves. So we're gonna beat this into your head one way or the other. I still think gross product is one of the most, I don't want to say misunderstood, but poorly, understood or least thoroughly understood concepts that we deal with in sort of our ranching for profit style economic analysis. It is a wonderful tool. The more I play with it, the more I love it. And it is a hugely important, the top end of our funnel, if you will, where the money comes in, is hugely important to what happens the rest of the way down. Gross product is, for a reminder, the definition is just the economic value of all your production. We want to make sure that it is not cash flow. We then take to sort of run through the whole profit equation. We take our gross product, we subtract our direct costs, and remember those are costs that increase in proportion with the number of units, so animals or acres, depending on what we do. Then we subtract our overheads. Overheads are not necessarily fixed in the sense that they can't be changed. They just don't vary with the number of underlying units. And then after that, that gives us a net income. Net income gives us the ability to service debt, pay taxes and interest, and a whole bunch of other things, and then actually create, put money back into the business and or create profit that can be removed from the business. Debt service is not included in our profit calculation. That's a separate issue. And profit is not cash flow. So the net income number at the bottom of your P&L probably doesn't resemble what's in your checking account. As I said, it's the gross product is the economic value you produce. That value is counted whether you sell it, whether you transfer it internally, or whether you just hold on to it. So I love to use the examples of retained heifers. When I add heifers to my herd, I increase the value of my herd, but I create no cash transaction, right? So there's no revenue that goes with that. Hence the difference with the bank account, for example. Also, it can go the other way. Sometimes we sell off the factory. So if there's a drought and we decrease our herd size, we are going to sort of take that away from our revenue number to adjust for the fact that we have decreased the value of our underlying asset base. And then gross product is very important because it helps us to remember what we call silent thieves. Sorry, I'll go back to that. So there are a lot of non-cash costs that can eat our lunch. There are also places where we don't understand how much value we're producing because we don't credit it as a sale. And again, revenue we've talked about a few times, but that is actual cash received. The equation for the trading account to get the gross product is pretty simple. We start by adding our closing inventory, our sales, and our transfers out, and we subtract our transfers in, our purchases, and our opening inventory. And that the summation of all those pluses and negatives results in the gross product. There are lots of ways to run a successful business. And what I see a lot in EL meetings and in other people ranching for profit scenarios that I talk to is a real focus on the gross margin and the gross margin ratio. And I like to make the joke here that size matters because you can have a fantastic ratio, but ultimately I don't pay any of my bills with a percentage. I pay them with dollars. So ultimately, while we can have a great gross margin, if we're going to have a profitable business, the actual gross profit has to be bigger than our expenses. In an asset-intensive business like a livestock business or a farm business, we can adjust the asset performance and we can adjust the size of the underlying asset. We have a couple of levers there that we can push on to actually change the outcome. So imagine you have a very big pile of assets that generates a small return, percentage-wise, right? We may be able to pay our bills with that. Or we could have a relatively small pile of assets that generates a big return. We may be able to pay our bills with that. Questions or comments up to now? Walter, anything you want to add to that?
Well, I think one thing that I think is a good one to remember is sometimes people get hung up on the size and bigger is better. Where I think there's something to be said for making sure that we have a well-structured, profitable business before we get into the real growth. I mean, if the goal is growth, that's fine. But sometimes, the bigger, truck to haul the watermelons that you're losing money on is not maybe the best deal.
Could not agree more. And if any of you are interested, Wally and I, a year ago or so, did a wonderful, I thought a great podcast with, I think, Jared Lumen on scaling a business. I think that was on the Herd Quitter podcast. And that was a fun one to do where we talked about exactly that concept. And Walter, that leads right into some things we're going to get to in a minute. So that's awesome. All right. I want to, if you have not heard of, I've talked about George Gilder multiple times here. George Gilder is what I think of as an economic philosopher. I think one of the things that often happens in our industry is we get super enamored with stuff. And if we really want to think about value creation and wealth creation, we cannot be overly enamored with stuff because wealth doesn't come from stuff. Wealth comes from good ideas. Wealth comes from creating value for others. And while stuff can hold value and can be a store of value, it doesn't create new value. And interestingly enough, most of the time, a lot of the stuff that we think of as assets actually costs money. So it depreciates, it rusts, it rots, it gets flat tires, right? It costs us to change the oil, that sort of thing. When we own assets, we have an opportunity to create value. We may or may not do that. So the underlying asset base is not actually the great predictor of what kind of wealth or value can be created from that. The best example that I am totally enamored with is, all of our technology progress has been built on one of the least valuable resources and one of the most abundant resources on the planet, right? The whole silicon revolution, right? The tech revolution based on one of the most abundant elements, one of the cheapest elements on the planet. It's not the silica that makes the difference. It's how it's used. It's how it's put into, how it's put into motion, if you will. Does that make sense? Yes, no, maybe so. We'll roll on.
Well, I mean,
Go ahead.
one piece there is, I think it's interesting, and you've probably heard this one, John, is that some will say that they're, I thought you were maybe going a different way, in that comment, but that piece that is out there that's so key, it's so key, is that photosynthesis.
Right. Well,
Yeah,
that's an even better one, right?
right.
Right. Doesn't cost a lot of money to get photosynthesis rolling, does it? Jed, do you have a comment? No, missed it. All right, good. Okay, there are lots of ways to measure asset performance, and we're going to look at a couple here fairly easily. I'd like to keep this as simple as possible. We can get more complex, but we're basically going to talk today about return on assets, which is a term most people have had, where we basically just divide net income by the total assets. And then we're going to talk about asset turnover. In both of these, sort of general, in the world of business, 25 to 50% is considered, a good or even, better than reasonable numbers. I think we see in both of these numbers with the customers we work with, there is almost not an upper limit. I'm sure there is an actual upper limit. But we see a range of numbers that is very, very high at times. We see lots of numbers that are low too, so don't despair. But we see the opportunity to have numbers that are, at 100%, and in some cases over 100%. And that is a reflection of the underlying strategy of the business and the sort of processes and approach to things where those highest turnover businesses generally are taking a fairly asset light approach with a lot of application of skill. We're going to look at this slide a few times. I would like a real vote here. So we have 4 enterprises. I have shown you the gross product and the gross margin percentage and the ingredients into that. So I would like you to shut your microphone off for a minute or make a comment or post in the comment of what business, if you were going to vote, which business here would you most want to participate in? And maybe some of us could give a reason. So Grant, can I pick on you to give a reason?
Yeah, absolutely. So I would go with entity 1 or enterprise 1. And this is just kind of off the cuff, but man, it looks like you're producing a huge amount of value with very little cost, to me, is what it looks like.
Okay, good. Very little direct cost, right?
Right.
Taylor, are you here that you have an opinion on this?
Yeah, I'm here. Yeah, I just think it's the most efficient use of the capital you have in the business, right?
Sweet. Good. And anybody want to argue a contrary point?
3.
3. Because it has $1 million top line?
Dollar gross profit.
Yep. Okay.
Yeah, I vote for number 3.
Okay, so we've got 2 for 1, 2 for 3. Anybody else?
Is this a trick question? You throw in overheads or?
Oh, Jordan. I hope you should know me better than
just
this.
question.
I've entered this sadistic period in my life where I enjoy throwing these things up in front of people and then trying to lead them astray as hard as I can for impact. Anybody else want to guess? Samuel, do you got an opinion on this?
3.
3. Okay, good. Hondo? Oh, we got some comments in the chat. Look at this. John Hondo says 1. Taylor says 1. Jordan says 3. And Hondo says because the gross margin's high. Walter votes for 3. Interesting. Tara Smith votes for 3. All right. So we got 1 and 3. Does anybody want 2 or 4? No. Okay. All right. Now the next slide is going to have more information. So just for you, Jordan, it's just so you know.
Thanks.
He says sarcastically. All right, these are your overheads. What do you vote for now? Walter's smiling. Walter's still feeling comfortable with his choice number 3, or does he want to change it? Tara, what do you think now? Oh, Tara went to 4. Okay, 0 overheads. It's a difficult business.
I'd go with 2.
Go with 2. Okay, why is that?
$100,000 profit.
Good.
That's pretty much all I've looked at so far.
That's a pretty good reason. I'll take that. Jordan Pelton is saying number 2 now. He agrees with Jordan Steele. Oh, Tara Smith wants to change her vote to 2. Okay, good. Tyler Berkey, do you have a vote on this? You're a savvy business guy. Walter Lynn says 2. Okay. Samuel says 2. Okay, I will say one of the tricks I did not make in this is a debt service. There's no debt service curveball here. So that's a good one. I'm glad you brought that up, Samuel. All right, we're going to add a little more information. The next one just shows the net income, right? So obviously we turned Enterprise 3 into a loser by adding a whole pile of overheads, which I didn't show you in the first one. Now we're going to go to our next line, total assets. What do you like now? Tara's brain just exploded. Just counting zeros there. Like, what the?
Number 4.
What'd you say, Walter? Tyler says 4. Taylor says 2 again. Walter, or is that from the last round, Taylor?
That was from the last round.
Okay. What do you say now?
I think I don't know. I'm between 1 and 3.
You're catching on that this is a bad game, right? There's a.
I'd go with 1. Why not go with $20 million?
Okay. We're in calculus now. I'm only at level 1 algebra, says Tara. Good. This is actually, I have been trying to figure out ways to make this webinar more interactive. This is the most interaction we've ever gotten in a webinar. So this is good. We're going to have to do more of this.
Is there a problem with, I'm sorry, with Enterprise 1, it looks like it's only worth something through assets. Is that because it's high in assets, but the net income
Really
is
high in
negative,
assets,
so it's
right?
only worth, so, right, and so is it really only a business worth something if it sells all its assets? Am I off base?
To me, you're totally right. Walter, do you want to argue with that? She's got the logic right? It's
Right.
the $20 million asset that's generating 100,000 in gross profit and a negative 20,000 net income. Seems like a waste, right?
Yep.
Okay. Okay, we'll move on. Return on assets. This is not 0, but there are so many zeros after the decimal point. It's effectively 0. Enterprise 2 is at 5%. Enterprise 3, as you can see, is at negative 13. And Enterprise 4 is at 38%. Anybody want to change their vote? And we're going to go one more here. Tyler says 4 is still good. Feeling like he picked a winner early. All right. Asset turnover. I'm going to add this metric to you for a couple of reasons. More than anything, I want to show some differences. All right. What's the consensus now? Which business would we rather be running?
Two.
Chad, what'd you say? 2?
2.
Okay. And why?
My lifestyle won't be supported with $30,000 of net income.
Good. I like it. That totally matters. I'm assuming we're paying you a wage out of the business, but yes, that's all right. Good. What else?
And if I ever need to go borrow money, I have $2 million in assets to borrow against. Not that I would want to, but there's a cushion there for cash flow reasons, operating loans and growth other reasons. I mean, I like 38% return on assets, but you know, I could have a business that has $500 and net income of $500, and I'm still going to starve.
Yep. Right. Okay. So this brings up the last curveball, and you touched on it. So I'm going to go ahead and jump to it. Which of these businesses, I remember I did turnaround projects for a while. Which of these businesses would you rather do a turnaround project on? Or which of these do you feel has the most potential to make big improvements?
Number one,
Why?
with $20 million, you got to be able to do something with that.
That is performing so badly, right? That it's like, how could you not make this better? Even if you took half of the 20 million and invested in a whole different business that actually was profitable, right? So, okay,
Like a
so
CD.
go ahead. Yeah, exactly. Anything else? Anybody else want to comment on that? It is really hard. If you have a business like Business 4 and you're in trouble, it is super hard to recover. Chad mentioned a couple of things, but there also isn't a lot of resiliency there, just because any kind of, significant drop in your asset value means you're living close to zero. When you have a $20 million asset, I agree that that's performing horribly. That is not a business I would want to sign my name to at its current operating state. But boy, if things go sideways, you've got lots of room to recover. And as Chad mentioned, if you had to borrow money, the 2 million or the 20 million gives you a tremendous sort of asset base to work against. Does that make sense? Anybody else want to comment on that or thoughts on that? Tyler, you got any thoughts? Tyler Dolly?
2 and 3 might be interesting to sort through and see what the opportunities are.
Totally.
You got $1 million worth of gross product, which is way above the others. There might be some opportunity to cut the costs out of that.
Totally agree. So where Business 4 is very short on assets and not that big in gross product, both of these with $1 million in gross product, like they're generating significant economic value, right? Either of those would be an interesting business to work harder on. And the cool thing
Never met a bank that would loan on assets alone. They all talk about cash flow.
Correct. In the world of ag, I'm afraid we do see some banks that loan primarily on assets and they talk about cash flow, but they are more and more focused on cash flow. I agree.
I know a couple of guys in New York named Guido that would do it.
Yeah. Oh yeah. But their intention is to get your asset.
That's right.
I've had the feeling in the past that I've dealt with banks that have a similar approach to Guido in the fact that they are looking at the ranch. Okay, anybody else want to comment on this?
I think you need a little more detail to actually be able to choose, because what if Enterprise 4 is like in year 1 of operations and it went from nothing last year or 6 months ago and now already has this? Like there's no historical information here to kind of like get a sense of the trend of the business. Was Enterprise 1, was that, is it a 100-year-old business that's stagnant, or is that, there's just not enough history here to kind of really determine. You're looking at a very specific snapshot in time.
Great thought. And that's actually exactly what I had in mind when I was putting Enterprise 4 together, right? It was basically a bootstrapped, think of something like a custom grazing business where the main employee is the owner who has a full-time job and doesn't charge the business any labor. Cool. Great thought. Any other thoughts along that line? Or along a different line?
When it talks about the asset turnover, some of it says one. Let me see. And what does that mean in terms of, like, if you were to put that in the cattle sense, does that mean how often you're turning over or selling your cattle?
Good question. No, in this particular case, I am doing this in dollars. So you may be turning your cattle over multiple times per year, which is also a use of the word turnover, right? We might buy stockers and turn them over 3 times a year. In this case, I'm literally talking about the dollar turnover. So it may be one turnover a rent, it may be 7. We don't know there. We're just looking at, effectively the dollar efficiency of that asset base. Good question, Danny.
Okay,
John,
so is it better to have a, I'm sorry, go ahead.
No, Danny, finish, because I think I know where Walter's going.
Is it better to have a higher percentage or a lower percentage? Sorry, I'm very elementary here.
Good question. Anybody else want to answer that?
yeah, let me help you, Danny. Okay, one of the things that what you're going to see is there's 2 numbers on here that come back, and you can derive your return on assets. So if you take your 30% gross margin times your turnover of 125, it's 37.5%. Okay, which is
Do you see that here? See what he's doing? 30 times
I think so, yeah.
125% is 38. Yep, great.
Okay.
Okay. And what you, I think sometimes we want to, and I'm not trying to beat up the, what we learn with Wally or Bud Williams or whatever, but I mean, Bud, God bless him, he had the ability to basically, he probably had an inventory. I mean, he could with his trades he was doing. He was probably doing, one per week, perhaps. So, that's I mean, if you do 1 per week, that's because, I mean, he would buy one place and sell another place. So he was really turning the inventory 52 times. But I think we got to think about is you have to look at your context, and it's a know thyself piece that we have to think about. So I hope that maybe would, because that gross margin and that asset turnovers are the drivers for the return on assets.
That's sort of and I think of this as a funnel, Walter, right? Money goes in the top. And so if we have a big wide funnel at the top, we have an opportunity for more of that money to make its way down. Doesn't mean it does, but it provides that opportunity, right?
Right.
Okay. Now here's the interesting thing, and this is the point I really want to make. I sit in a lot of meetings where people focus on the gross margin percentage. And I am not saying that is not an important percentage. That's incredibly incomplete. When I hear an EL board say, oh, you need to run the numbers, and that's the level they're talking about, I feel the need to remind them that that is very, very incomplete. Jordan, do you want to add to that?
Nope, you nailed it. Got to look at the whole suite of numbers, not just one.
Okay.
And then you also, you might get into this later too, but after you look at numbers, then look at your quality of life, your employee satisfaction, your mission, your vision, stuff like that too.
Very good. I am not actually going to get into that today, but I'm thrilled you brought that up. Yeah. And that relates to Walter's point, right? Which is, don't choose a business strategy that is not something you can do, right? So when he talks about Bud having the ability to do a trade every week, that is not something most of us mortals can do, right? That is a remarkable skill set that it takes to do that. Now, a lot of us could do 2 or 3 times a year. That might be okay. But we have to make sure, just like you're saying, we're operating within all of those other sort of logistical and operational and environmental constraints. We have a context. I really do love HMI's context construct, and that is a great way to think about things. All right, so here's what, now that we've gone through those, I want to show you a few examples from the wild. And I'm going to ask you to, I've just clipped these out of a report that we produce internally here. And I'm going to ask you to just ignore this return on equity for right now. We will come back to that, but I've just clipped out some real business numbers where we show the return on assets. Remember I said some of them get a little high, and then we look at the gross margins. Okay. And then we look at the asset turnover. So remember, the gross margin is excuse me, let me start at the top. Return on assets is the net income, which is the bottom number on your P&L, divided by your opening asset number. And we run that by producing a multi-month P&L that goes December to December. We start with the December 31 close. We use that prior year asset number as the start. We also calculate this sometimes as the average of the assets, where we run it for 12 months, take the number for each month, divide by 12, and then use that number. They come up pretty similar. But again, this business is running basically 84%. In the wider business world, this is a big number. Walter, how often do you see a number this big?
You don't.
Are you suggesting these numbers are wrong?
No, that's not what I'm saying, but
It's big.
Well, it's a big, and I think you have to compare it to other places that you can get an ROA on.
Yeah.
So
Agree.
I think you and I have talked before is, are you getting a return better than maybe the mutual fund that, is in your retirement account?
Yep. And I would say in this business, it's absolutely yes.
Right.
The family that runs this business, if they say, man, we want to pull a bunch of money out of the business and invest in mutual funds, be like, that's a super bad idea. And if we looked at their 3-year number, you would be impressed by the 3-year number. Note, this is last year. We did see some good numbers last year. The businesses like this one, where we saw really good numbers last year, had really good numbers the year before, and generally had really good numbers the year before that. So this is less influenced by market than I would have thought even a few years ago. The other thing I want you to notice, this business also has good gross margins. And again, this isn't an either or. If you can do both, ultimately my focus is on return on assets. But to get our high return on assets, you are often looking at good gross margin ratio, and you'll notice good asset turnover ratio. Okay, so again, return on assets is just the net income divided by, again, bottom of the P&L divided by the bottom, the bottom of your asset class from the prior year, end of the prior year. Your gross margin ratio is the gross product divided by the gross profit. Okay, how much of that money do you keep? And then the asset turnover, again, this is not a number of times, Danny, as you were asking about. This is just how many dollars of gross product are you generating from that average inventory? In a lot of things, I have converted from using gross product to gross profit because I feel like it standardizes across industries better. I have not done that with this metric, and I can't tell you exactly why, but it doesn't feel like it works quite right. We wind up incorporating too many variables in one place. All right, questions about this one? I got more, so. No? Okay. Here's another one. Now, one other thing I want you to notice. This business is operating on what I would consider a moderate sized asset base in our industry, right? 1.6 million, 2 million in assets, 1.6 in equity, 2 million in assets, not a lot of borrowed money. And this is a huge amount of assets, but it's not trivial either, right? Next one, we'll notice this is a little bigger pile of assets, and I want you to notice that it's a much more heavily leveraged.
You're not including land, right? No land.
This is
no
land out.
yet.
Correct. That's exactly right. Land is out. So this is 5.2 million in livestock in this particular case, and some feed. Yeah.
And then the land debt is also out of these numbers too, right?
That is correct.
Okay.
Yep. All right. Now this is an interesting case because the gross margin numbers are not as good. The return on asset number is not as good. The turnover numbers are they're definitely above average, I would say, but also not as good. When you look at kind of to Chad's point earlier, this business, I promise you, is generating the type of income that could support the lifestyle to which I would like to be accustomed.
John, could you define gross profit real quick?
You bet. Gross profit is I'm thrilled you asked. Thank you. Is the gross product minus the direct costs. So the difference here is, feed, vet, tags, brand inspections, trucking, that sort of thing.
Okay, thank you.
You bet. Great question. I'm glad you asked that, Taylor. Does everybody understand that? If I need to repeat that, I'm happy to. The gross profit is the gross product minus the direct costs. Okay, questions about this business?
I just need a little clarification. You just said this, but I missed part of it. For the value of the assets, you're only including the value of the livestock, not land, not M&E, nothing.
No, machinery and equipment is in here.
Oh, okay.
But it's the operating business assets. Yes, but not. And so generally we take the land out. Try to follow the ranching for profit example there and just do the operating business, and then separately we do the land business.
Okay.
Good. Danny? No? All right, let's do another one. The other thing I've learned, we're trying to make these more interactive. I also realize that more examples is how people learn math. And so that's why I'm trying to incorporate more examples. So if these seem repetitive, they literally are. Okay, this business has, again, we're pretty significantly leveraged in this business. This is a smaller business with a smaller return on assets, right? Net income still positive. We have pretty good stocker gross margin. That I would classify that as okay, not really up to standard, but depends on the context. If this is a feed yard, for example, this is quite good. If this is an extensive grazing operation, it's marginal. Cow-calf gross margin, I would say, is poor. Sheep margin, don't be fooled by the great percentage. When you divide a negative by a negative, you still get something negative. So that's fairly bad. But when we look at our asset turnover here, the stocker asset turnover is, I would say, very good. Generating 100% of your asset value is pretty impressive in gross product. Cow-calf at 50%, I would say, is also very good. I showed you some good ones to start, so you might be a little jaded now and think that they all ought to be 80%. But again, remember, the wider business world considers 25 to 50 really quite good. And again, the sheep divide a negative by a positive and you get a negative. So obviously this is like a trivial part of the overall business. So the dollar numbers here are not enough to support one in the lifestyle to which we would like to become accustomed. Questions about that one?
Could you remind me the difference between equity and assets? I understand assets is the land or the things that you do, but what's the equity? Is that the uncollateralized asset?
Correct. Yeah. Take the assets, subtract the liabilities, and you have the equity. And I'm thrilled you asked that. Sorry, I meant to explain that at the beginning. So if the rest of you were wondering, thanks for equity is the value of, effectively at the end, it's the value of the business when you add all the assets together and subtract all the liabilities.
And so generally speaking, you want your assets and your equity to be as close as, either 100% or zero as possible, right? You would prefer not to have any liabilities tied up tied to your assets.
That is a great question and is going to be a wonderful lead in for next month's where we're going to start a series on debt. And I would actually say no. Now, if you are a Dave Ramsey acolyte, which I don't have any problem with, and you don't like debt, then yes, you would like your equity and your assets to be equal. That means there's no leverage in the business. There are no liabilities. While I think that's what utilize that in my personal life 100%, and I am not a big consumer of debt, even in our business. That is not necessarily the best strategy from a numbers standpoint. I tell people all the time, I deal with people who are either terrified of debt and never want to have any, or who are so enthusiastic about it they scare me. I prefer sort of a middle ground where we use debt as a tool effectively, but we make sure and keep it from either strangling us or cutting our head off.
So another way of looking at it, although I guess I'm jumping into next month, is if you have equity on your assets, you're like, hey, I see an enterprise where it might generate more than the cost of borrowing the money, then that is where you would say, hey, I can generate a higher return than the cost of the money, right?
Correct. And I would say, as long as that margin is big enough that it takes risk into account. Does that make sense? So if I'm going to generate, 1% difference, not that interested. If I'm going to generate a 15% difference, now I'm interested. Walter and I looked at an example where the difference was like the return on, the return was around 40%. It was 39 point something percent. And the effective cost of borrowing was about 3%. That's a pretty good margin. That leaves room for things not to go very well and still to cover your interest expense. I see lots of cases, and we saw this. Remember, a couple of years ago, we started encouraging people to do some stress tests based on interest rates. And when we were all very comfortable with interest rates that were 2.5% to 3.5%, when we said, hey, what would happen to your business if interest rates went to 5 or 6%, that showed that a lot of people were sort of on the border of trouble, right? Because they didn't have enough, there wasn't enough profit in that borrowing to make it sort of worthwhile when the interest rates doubled. And ultimately, interestingly enough, interest rates doubled.
So theoretically, if I were to create a narrative out of this, that totally made up, of course, that this operation was like, hey, we see a potential opportunity here in sheep, so we're going to take out a loan on our assets, decrease our equity, put it into sheep, and hope we get a better return. And this is their first year, and they didn't know what they were doing, and the sheep lost them a ton of money, but they're still hopeful that the sheep enterprise is going to eventually outpace the cost of the money to get into sheep.
That is possible. If you gave me these papers and said you wanted to borrow a bunch of money on sheep, I would raise every caution flag I possibly could. Walter, do you want to add to that?
Yeah, I will a little bit. I mean, one of the things that we're looking at here is what we do. We'll take that equity number times. I mean, I'm trying to not get in the weeds, but I mean, what you're going to do, you got an equity number and a debt number, which that's the sum. Those two added together is your total asset number. Okay, but when you take that ROA times the debt, okay, and then take your interest off, you want a margin. And that's where John and I were talking about, he said that we had enough in there. I mean, and so that's a pretty interesting little computation to actually do. I mean,
tune in next month.
Yeah, right. And but the other piece of this too is I'm gonna get in your first column of numbers, the piece there that you sometimes can do. You really would like to see an ROE when you make a fraction. You really want the ROE. You got the ROE. And you got the ROA, you want that greater, and if you don't, you got some structure issues.
You're out. Yeah. Good. We're going to get into that in detail next month, so I don't want to go too far with this. That's super good, Walter. But
Right.
These concepts all kind of interplay. And one of the reasons why I wanted to emphasize this a little this month is to build to that next month. And I think that the impact of debt in our business is something we can study fairly scientifically, or fairly numerically. How does that sound? And it adds a lot of power. So we will get there. Tyler, I am not against debt. I'm also an advocate for being very cautious with it. So I talked to a lot of people that don't want anything to do with that, and that is perfectly fine. We talk to other people that don't mind it. Well, that's okay too, as long as we're smart about it. Any other thoughts, comments? All right, I'll give you another one here. The other thing that Dallas has talked about publicly, Dallas and I have talked about privately, there is a bit of a bias in the ranching for profit world against cows. And I think a business like this one shows that, and I'll just say the follow-on numbers, if we add all the overheads, go right along with it. The cow business can be a great business. And if you live north of I-70 and don't think you should be in cows, that may be, but it might not be too. Lots of people that have significant winter think that they should be out of the cow business. And I strongly disagree with that. Not saying that isn't the case, but we see lots of cases where cows are very, very profitable. Depends a lot on management, and your results are not necessarily representative of what is possible. So I caution people on that when they take the school and then kind of want to get out of the cow business. A year ago, when cow prices went up, everybody at a number of meetings I was at, most people when asked were like, man, we need to sell our cows because they're high. Well, the profit potential for cows also was high. So while I'm all for selling the overvalued and buying the undervalued, if it has the ability to produce significant profit, I don't want to sell early.
You go back to that slide. Could you just give me a narrative of what that business looks like? Is that buying and selling cows all the time? Is that, how does that business operate?
That's a super good question, Tyler. And I cut a bunch of these out of individuals, and I am going to be able to tell you that I don't entirely remember. This, I do know for a fact, this is not a high turnover cow herd in the Wally Olson style, raise them until 5 and then sell them. This ranch obviously has incredibly low feed costs, right? Their direct cost inputs are very low. And if I remember, this may be a case of breeding Charolais on top of Longhorns, but I'm not sure that is the example. But effectively, they've got a very low cow value and a high calf value. But actually, that would not be this case, because in that case, we go to a stocker enterprise with those calves. They actually feed those all the way to the rail. So I'm going to tell you, I don't know, but we have a low value cow herd, and we have some pretty good gross product.
Okay. I was just kind of curious.
No, it's good. It's a good question. And I probably should have written a narrative down for each one of them. I wanted to set some boundary conditions. I believe this is south, either deep south. I don't think it's southeast, but I want to say it's like Oklahoma, Texas, Louisiana-ish. All right, here's another one. Okay, the biggest lesson I want to come away from in this is if you have a negative net income, that you can't really recover from that. Talked about this before, right? Negative net income erodes equity. Negative net income makes everything hard to do. We've got to make sure we get out of that particular situation. And where are we at here? Okay, here's again, if we look at the ROA here is reasonable. This is a pretty nice ratio, I would say. We have a poor cow-calf gross margin. We have a very good replacement heifer gross margin. We have an excellent sale bull gross margin. Jordan's going to tell me he's suspicious about this number right here. We have a very good stocker gross margin, but again, the numbers are pretty small. And we have what I would consider an okay to excellent set of turnover numbers. I would put 9% in the unacceptable. I mean, you know, if we're going to skate around this area, we don't need to really be involved. 21% I would say is, you know, in the realm of we can continue, but we'd like it to be better. But again, if you figure on average, you know, a really good number is 25 to 50, 21 is bumping right up against that. All right. Any questions on these? All right, let's go now. Remember, our goal is gross product here, okay? We're trying to get to how do we generate the best gross product? Now I want to get into this Kiyosaki ratio, and this is the part that as I look at different businesses, as I look at farms and ranches as one sort of division, as we look at North and South, as we look at different segments of the industry, you know, feedlots versus grazing operations, direct consumer operations versus, you know, sort of a commercial cow-calf type deal. This is something that shows up a lot. When we talk about gross product, right, we are talking about economic value creation. On all of this, I'm going to say makes money, but what I really mean here is it creates economic value. Now, we may convert that to money or not. That's our choice in any particular year. But basically what I want to do here, I assume everyone here has at least heard of Robert Kiyosaki's book, Rich Dad, Poor Dad. He's got a few others, the cash flow quadrant. I think he's got 4 or 5. Anyway, he talks very adamantly in there about lessons he learned from his rich dad. And his rich dad had a different definition of assets than your bank has. The biggest distinction, he said, assets are things that put money in your pocket. Liabilities are things that take money out of your pocket. So I'm going to tell you that if we tie up capital in things that make money, and only things that make money, we give ourselves a massive unfair advantage. Okay. Why? Because things that are assets to the bank and not assets to Robert Kiyosaki don't put money in our pocket. Okay. When we're talking about gross product, we are talking about either things that put money in your pocket or will do so in the future if you choose to sell them. Generating economic value is like a leading indicator for cash flow. Tractors, trucks, trailers, tractor implements, tools, you know, all of these things that rust, rot, and depreciate, right? They don't put money in your pocket, and most of the time they cost you money to own. I can choose to leave my pickup sit for a long time in my driveway. It is still going to cost me money. I'm still going to pay property tax on it. And I guarantee if I leave it sit for 6 months and come back, the first time I go to try to start it, something is going to be wrong, right? A battery is going to be dead. A tire is going to be dry rotted and flat. You know, the oil is not going to be where it needs to be when I first start it. Like something's going to go wrong. Leaving equipment to just sit and thinking that not using it helps our financial situation is generally incorrect. We either own it and use it, in my mind, or we don't use it and we get rid of it. Livestock, crops, and feed, on the other hand, are again a wonderful part of our business because we can own them. They are categorized as assets. We can borrow against them, all kinds of things. They put money in our pocket. A cow, the whole reason to own a cow in a profitable business is for that cow to make money. And oftentimes those types of assets can be self-sustaining, meaning they can feed themselves and care for themselves. They even reproduce themselves. Walter mentioned the photosynthesis equation early on, right? I mean, cows go and they just hang around on our property and eat some grass and make more. Like it's literally the easiest business there is. But again, the whole idea is that these types of assets put money in our pocket. So what we do is we break your asset pile into 2 things. And Tara, you asked about machinery and equipment and that sort of thing. We generally take that machinery and equipment category and we call those non-cash flow producing assets. We take your feed, your livestock, and, you know, there may be a few additions to that, but that's basically it. The feed and livestock accounts, and we put those in the cash flow producing asset category. So we basically take the cash flow producing assets and we divide by the total assets. Possible values there range from 0 to 100%. At 100%, it means that every dollar you have invested in an asset is generating income. At 0, it means that everything you own does not generate income. Custom farming business would be a bit of an exception in this, but again, the custom farming business, the equipment actually does generate revenue. I just grabbed a couple of, from some of these same businesses, grabbed some Kiyosaki ratios. Amongst our customers, we see numbers below 20%. We have, I think, numbers below 10% or a number below 10%. We see the highest one is effectively 99%, and I had to add back value on the pickup to make sure that it was a reasonable market value, not a tax depreciated number. Again, we're just looking at cash flow producing assets versus non-cash flow producing assets. 84% means that 84% of the money you have tied up in assets has the potential to make you money. Now, when we talk about an asset return ratio of 25%, where this gets to the gross product is, of course, the bigger this cash flow producing asset number is, that's the number, it doesn't necessarily what it's bigger or not, but whatever number that is, that's what you're multiplying by your asset turnover to effectively produce your gross product. Questions about these? Does everybody understand the calculation? Everybody understand the concept? The more stuff you own that makes money, the more money you make.
You have a question in the chat, John.
Oh. Now, where do I find that? Hang on a minute. Can you see it or read it?
Yeah, Tyler asked, would pasture count as feed?
Generally not, but it could be. We have a banker that will count residual pasture as an asset, but generally we leave that off. I think in your own mental math, it makes sense to count it as an asset. I think when you go to the bank, it probably makes sense to leave it off. Walter, do you have opinions on that? Jordan, you might have opinions on that too.
No, I don't.
Kind of agnostic.
Yeah.
Jordan, anything you want to answer to that?
I would probably rather not. It's pretty subjective. If you are wanting to include it, make sure you include it every year. Because if you have different assets coming on and off the balance sheet, that's going to give you goofy swings in equity.
Yep.
It's gonna.
Good.
The last thing I would add is the residual feed. It's going to show up in next year where you can either run more cows on the ranch or you don't have to buy hay. So it's going to wash out in the end. And that's where I'd rather see it.
Yep.
Hey,
Yeah.
John, Jordan brought up a good point that was on top of my mind. Yeah, how does this all relate to capacity? And like his point was, if you had more residual pasture, then next year your capacity is different, right? So if you wouldn't be comparing 100% capacity year to year, or your 100% capacity from year to year would be different, wouldn't it?
Yeah, and I think I always plan on it being different, Taylor, no matter how static an individual ranch or farm is. I think between weather, markets, and other production risk, I think we can just plan on these being, they may hover around an average, but every single year is going to be different. I think if you're a long way away from a reasonable carrying capacity, I think that has the ability to sort of skew things one way or the other. So let's say you're, and I pick on Tara Smith's country, right? You guys were in bad drought for 3 years. Herds got small, lots of stuff got sold off. There is going to be a year or two of building back that's going to be a little weird. And in part because, basically overheads are high relative to what you're running. You're trying to buy in cattle, buy in or grow cattle of some kind, like you really are on a very different trajectory than you were 3 years ago, 4 years ago when you were destocking for that drought. the nice thing is gross product tends to take that into account. I don't think it corrects all of it, but it does absorb a bunch of that where we essentially discount the income that's coming while we're selling off for a drought, and we also discount the costs that are coming when we restock. So I don't know if I'm answering your question.
No, that makes sense, especially if you're far away example, like Tara's example.
Okay. Take this lower left Kiyosaki ratio though. If we go into a drought and we have to cut our herd size in half, our Kiyosaki ratio is changing, not necessarily because of our management. It's changing because of extrinsic weather. So I expect those numbers to bounce around some. Again, I'll just say that the people that have really good numbers in good times tend to have really good numbers in bad times. The year-to-year variation is not quite as big as one might think. This would be an obvious example for that, right? It's hard to get off 99% when you only have $10,000 in non-cash flow producing assets. Some of these, like the lower ones, though, it would have a more outsized impact. Good question. Anything else? All right, let's go one more. I mentioned the turnaround thing when we talked about our different examples. Again, which of these would be an easier business to fix? Which of these businesses would you rather take over right now at its current position? And I think I'll just say there are some differences here. This first one with a Kiyosaki ratio of 2%, that means that 2% of their assets are cash flow producing. My first thought is that, man, if I could make that 20%, this would be a very different operation. Right? Because suddenly my $110,000 in overheads would not be very much, they wouldn't be an issue. I'm not saying that the overheads are going to stay at 110 if I go from, if I change that tenfold, right? But they might. I will say again, I've mentioned that when an enterprise like Enterprise 4 here gets in trouble, this is probably a new, relatively young business. But if this business gets in trouble, there isn't a lot of resiliency there because there isn't a lot of junk you can sell that doesn't impact the operation of the business. And Tyler asked, would pasture count as feed? Okay, so that was the question from before,
Yep.
right? Okay, good. And then depends on liabilities of one, may sell and move to something else. Yeah, very good. I didn't include any debt information on this. Good, very good point. That may, yeah, if you have 21 million in debt would really change the appearance of that, right? All right, any questions about this? Again, I want to make a couple of points here. Gross margin percentage, definitely a useful metric. As with any metric, whether you are breeding cows, selecting bulls, growing grass, running a company, looking at financials, any metric of any of these metrics in isolation is bad, incomplete, will not get you where you want to be. There is no, as much as I love the Good to Great book by Jim Collins and his, there's like one KPI that drives the whole thing, like, yeah, kind of. But when we look at these things in isolation, we can get ourselves into trouble. Don't, and I don't mean this quite this accusatorily, but don't be lazy and stop when you do your gross margin percentage. That is incomplete. We need a lot more info. The other thing is I really want to make sure that we understand that most of us are in the asset management business. If we manage the underlying assets correctly, we make more money. Better asset managers in our business make more money. This is a managing the business type thing. What does the business choose to own? Right? What does the business choose to invest money in? That often has a bigger impact on the ultimate performance of your business than whether you get a 92 or a 93% weaning rate, or whether you wean a 500 or a 525 pound steer. The decisions that are made in terms of, choosing what, where, and why with the underlying assets have huge consequences. And most of us do not focus on that. Most of us really stay focused on the production side. I am not saying that production is not important. Production absolutely is important. And as Jordan and Walter have both pointed out, you kind of have to know yourself and your context and operate within that. That said, there are a lot of money decisions that can be made that have, again, with no performance component, make big changes in how profitable our business can be. So with that, I will wrap up. I am super thankful always for the ongoing conversations I get to have with Wally and Walter and a whole bunch of people from Ranching for Profit, including Jordan and Dallas. I am super thankful for the last couple of years. This has been so much fun for me as a bit of a data nerd to be able to look through, 100 or 100 plus companies on a regular basis and see what is happening. I think that, like I say, this has been more educational for me than anyone else. So this company in some ways is an entirely selfish endeavor. So that makes it a lot of fun. Any other questions, comments, or thoughts? Really? None? So thoroughly covered, you absolutely understand it? So confused, you forgot to ask the question at the beginning that you were shy about? Walter,
Exactly.
No, go ahead. Yeah.
No, that's it.
Walter, you want to add anything?
I mean, the big picture thing, I think you still just have to keep going back and understanding this. And it's okay to do that. And I'm glad that we're reinforcing, what you're doing here, John, because I mean, I think, you're taking this to, I mean, I'm not beating Dallas and, the RFP team up or anything, but I mean, what you're doing is you're making differences where people and their profitability, they're going to be able to go on with the next generation. They're going to understand how to bring that next generation back and to make that difference in their community. So, and I'm in the one that, there's a social piece to this, and that's the know yourself, and then there's the economics, and then there's how you deal with the ecological piece of what the land base that you have. So it's not, you just have to be aware that you've got to be managers to make that return so that you can have that number for your family living and have that number for your debt service, etc. So, and another piece that I think that John and I have talked about in the past is, I think that, sometimes we get hung up on that land piece, and a lot of where John is going here, he's taking that land piece out of the equation. So it's not messing with your head.
And just for the record, single digit numbers on the land are much more typical, and often single digit numbers below 5. So that's also one of the reasons we don't blend these things, right, Walter? Because if you average a 3% land return and a 50% operating company return and then divide by the total value of the assets, you come up at like 3.5% a lot of the time, right? Or maybe 5%. And so that really skews the size and slow performance of that land really skews the combined numbers. Good. And I'm glad you brought that up, because I meant to bring that up from what Jordan had said earlier too. Good. Okay. Any other thoughts, questions? Just out of curiosity, if give some indication if you feel like you could calculate your return on assets with your current financials. I got one thumbs up.
Well, I was actually going to ask, I was looking at my QuickBooks online and I was like, wait a second, where am I going to pull the numbers out to do this? And is this coming out of my chart of accounts, my balance sheet, you know?
Perfect. P&L and balance sheet. That's all you need to do this. And Tyler, you and I are going to walk through this soon.
Dun, dun, dun.
Okay, Tom Nichols says no. Fair enough. Josh?
Yeah, I got a question on it. Is this all annualized or can we
Great
go
question.
off of, like,
Yes.
should we percentage like total income as a 5 months out of 12 and do a percentage to try and
You can. Everything I've done here is annual.
Okay.
Yes. Walter, do you want to comment on that? I know you have some strong opinions about using real annualized numbers as opposed to annualizing numbers.
Well, I mean, one thing I think we gotta, and I mean, I think Jordan and John and I'm, you know, don't do the darn balance sheet as, you know, I mean, you know, the day before your operating loan. I mean, you're going to do yourself a better job of doing annual 12. I mean, if you got a December 31 year end for your business, I'm assuming that, you know, 90% of you, you know, here will do everything at 12/31 instead of if your line of credit is March 1st, don't be doing, you know, January or February deal. I mean, and and I'm in the opinion that your lender's not doing you a favor if he's jacking you around on that. So because I think what you're trying to do is to get consistency and patterns and trends, because what you want to do is that if you want to go in and you want to change something in the operation, that history that you have is powerful. So that's maybe some wisdom.
So the history and consistency, right, Walter? That's a big
That's
part.
right.
We tend to do a very good job at the end of the year of doing everything the same. And that's one of the things that, like, oh, was it March? Was it April? Well, it depends, right? And those things vary. But at the end, and we make an effort to, for example, even if you haven't weaned your calves, we put them on the balance sheet 12/31, no matter what. Because again, we want to make sure we create that solid annual picture. Now, that said, for non-bank use, sort of personal use, Josh, where did you go here? You're in here somewhere. Yep. I don't have any problem with looking at this to see where you are as far as are you on track or not. But you definitely need to keep a few things in mind. And so one of them being, you know, do you have a crop of unweaned calves that we generally don't put on the balance sheet until they're weaned or December 31st, right? So we would want to keep that in mind. That would be for lots of cow-calf producers, that's a significant current asset that goes unreported through the summer, right? Same if you have a half-grown corn crop, right? Corn is an incredibly expensive crop. It's also very valuable when you sell it. But if you're growing 100-day corn and, you know, you go to try to harvest it at 50 days, you don't have very much. You're not going to make your $600 establishment cost back.
I was just thinking as being able to kind of check performance through the year.
Yes.
What I was kind of getting at.
And we will pretty regularly run those numbers like at the end of a quarter or something if we're going to do a meeting. Yep. No problem with that. Cool. What else? Brett, good to see you.
Hey.
How's the farm life in Canada?
We're trying to beat the rain again. Nothing new here.
Good.
I'm trying to figure out how to mute myself.
It's pretty quiet when you're not talking, so you're all right. Kind of rough field there, man. You should do something about that.
Never mind the fields. That's our roads.
Oh. Manitoba Department of Roads needs to get after it, huh?
Can you tell them that too?
Yeah, I'll call.
Oh, thanks. Appreciate it.
All right. Any other questions or comments?
Did he want us to call Trudeau?
Yeah. Good thing about a bumpy road is it gives you, you buy more fuel so you can pay more carbon tax and then therefore generate more GST. If you don't know, Canada has this new awesome system where they charge a carbon tax because, of course, global warming is we're all going to burn in a fiery hell if you listen to people like Justin Trudeau. While we're still on Earth, just for the rest of you that aren't up to speed on that, they charge you the carbon tax and then they charge sales tax on the carbon tax. So your sales tax isn't calculated pre-tax. You buy fuel, you pay carbon tax on that, and then they charge you sales tax on the fuel and the additional carbon tax. It's a brilliant system. It's the reverse of compound interest, compound taxation, taxes on taxes. I'm a huge Justin Trudeau fan. For any of you that don't know, I think he's definitely leading our way in the U.S. here. They're only a few years ahead of us. I think if we continue on our current track in 8 years, we'll be at the same point. So prepare to surrender your guns and ride your bicycle to work. Which reminds me, the other day I had the honor of speaking after Don Day, who, if you don't know him, he is a big regional weather guy here in the Rocky Mountain region and the Western Great Plains. And he gave what I thought was the most comprehensive review of the sort of popular global warming literature. And it was awesome. All that stuff that kind of lights my hair on fire that people say about how the Earth is going to turn into a fiery comet burning through the sky. He has some pretty good counter evidence, and most of it he's taken up right out of the intercontinental climate, whatever their thing is at the UN. He's kind of taken their own data and used it to contradict their own statements. Pretty awesome. So we're gonna try to do a webinar with Don Day here before too long, but that's another channel. So we'll talk about that. Don Day also has moderated our outlook for the summer. So if you're in the Southern Great Plains, you're probably not going to be as wet as you thought you were going to be. And if you're in the North, you're probably not going to be as dry as you thought you were going to be. So that was nice of him to do. All right. Any other questions? Should we wrap this up? Tom Nichols, you said no about calculating it. How far away are you? Like, what would it take to get you to the point where you could calculate it? You may not still be there. We'll ask him next time. All right, very good. Well, with that, let's wrap up. Again, thank you very much, all of you, for coming. Appreciate the time. I had asked a number of people at the beginning how they were hearing about our webinars because our attendance has been up. Most everybody said email. If there's a different answer to that, I'd love to hear it about how you're hearing about these things. We tried to get it out through email and social media. Glad you guys all came. Hopefully this is helpful. If you have feedback, I would love to hear it. If you would like to run through and calculate your own numbers, obviously we're here to help you do that. And try to make it so that you can use these to guide you. Again, one of the things that distinguishes our customers and Ranching for Profits customers is that this is a group of people that believe that by knowing their numbers, they can make things better. I believe that to the absolute core of my soul, and I think nobody's done more to teach me that than Walter. In conjunction with Wally, who I think has taught me that not only can I make a difference by knowing my numbers, I also can free myself from a whole bunch of other things that I thought had a big impact, like weather and markets and personalities and location and all those things. If you have not done it already, we strongly recommend the Ranching for Profit class. It is the perfect springboard into what we talk about here. I think of it as kind of a prerequisite. They do a fantastic job teaching the class and teaching a lot of really good basics. What I would really like to do is be able to continue on with what they teach and just continue to augment that. I absolutely love their program. I love the people involved in that program, and they have always been very supportive of us. And I'm really thankful for that collaboration. So thank you all for coming. Appreciate it. We are going to do this again next month on the 3rd Thursday of the month, and we will see you then. Thank you.
Thank you, John.
You bet. Nice to see you.